Have you ever wondered how banks make money? You deposit $1,000 into your bank account, and the bank may even pay you an interest for keeping your money there. So, how does the bank make a profit? The answer is surprisingly simple. Banks make money by putting money to work. Let's break this down. Part 1, the main business. Imagine you deposit $1,000 into your bank account. The bank doesn't just put your exact $1,000 into a vault and leave it there. Instead, banks use deposits as part of the funding for loans and other investments. For example, suppose a bank gives someone a $100,000 mortgage. The homeowner pays interest on that loan. If the bank charges an interest rate higher than what it pays depositors, the difference can become a major source of profit. This is called the net interest margin. Here's an example. Imagine a bank pays depositors an average of 2% interest, but it earns an average of 6% from loans and other interest earning assets. That 4% point difference is an important part of how the bank makes money. Of course, real banks have more costs and risks, so they don't just simply keep that entire difference as profit. Part 2, where the money goes. Banks can lend money for many different reasons: mortgages, car loans, student loans, business loans, credit cards, personal loans. Each loan can generate interest income for the bank, and because many banks make thousands or even millions of loans, these small amounts of interest can add up to huge numbers. But lending money comes with a problem. What if someone doesn't pay the bank back? That is called credit risk. Banks have entire departments dedicating to analyzing browsers and deciding who is likely to repay their loans. They also set aside money to prepare for potential losses. So lending can be profitable, but it's definitely not free money. Part 3, fees. Interest isn't the only way banks make money. They also earn money from fees. For example, banks can charge fees for certain account services, wire transfers, overdrafts, ATM usage, and other financial services. Credit cards are another big business. When you buy something with a credit card, the merchant usually pays a small processing fee through the card payment system. Part of that money can eventually go to the card issuing bank. Banks can also earn fees from businesses and investors for services such as managing money, processing payments, and helping companies raise capital. So even when a bank isn't earning interest from a loan, it can still earn revenue by providing financial services. Part 4, why banks need so much money. Here's where things get interesting. Banks don't just have to make money, they have to manage money constantly. They need enough cash and liquid assets to handle withdrawals. They need to follow financial regulations. They need technology and cybersecurity. They need employees, buildings, customer support, and fraud protection. And they need to prepare for borrowers who do not repay their loans. That's why banks' revenue can be enormous while its actual profit is much smaller. Part 5, the big picture. So how do banks actually make money? Think of a bank like a financial middleman. People and businesses put money into the banking system. Banks use those funds along with other sources of financing to provide loans and other financial services. They earn interest, they collect certain fees, they provide payments and investment services. And after paying their employees, technology costs, operating expenses, interest expenses, taxes, and losses from bad loans, whatever remains contributes to their profit. Alright, so let's come to a conclusion. So the next time you deposit money into your bank account, remember, your bank isn't simply storing your money. It's running a massive financial business where money is constantly moving between savers, borrowers, businesses, and investors. And that's the basic idea behind how banks turn money into money. If you enjoyed this explanation, subscribe for more simple breakdowns of how money and the economy actually works. Thank you, bye-bye.